Hello, it's Jonathan Wellham of Rocklinc Investment Partners, and it's August the 26th, 2015. Well, so much for the summer doldrums. It has been a wild ride, especially in the month of August. So I don't think I have to tell any of our investors about the volatility that's taking place in the market. So let's give you a couple of points here just to give us a frame of reference for some of the significant moves that have taken place. If you take the Toronto stock market, the TSX as they call it, so far in August alone, the market is down as I am doing this video, and of course that can change even as I'm speaking, 9.5% so far just in August. The index is down about 9% on the year. So in the month of August so far, in the first 26 days, we've given up actually more than we had earned the whole year so far. So a lot of volatility just in the last, actually in the last few days. Over the last year in the TSX, if you go back to August 2014, we're actually down about 15% on the index. And a significant amount of that, of course, is the oil sector. If you look at the S&P 500, which is the large U.S. companies, the S&P 500 is down so far in August 11%. So that's what you're hearing a lot about in the news, this volatility south of the border. So far, year to date, the S&P is down 7%. So that's a significant drop after being up quite a bit. And year over year, going back to August 2014, the S&P 500, the big cap U.S. companies, is actually now negative about 3%. So some incredible rides. You've probably also been hearing about the price of oil, and most of you are aware of that also. And if you just look today at the price of oil, it's about $39 a barrel U.S. That's for the West Texas Intermediate. Now, if you go back and you look at the high in oil over the last year, the highest point for oil going back 52 weeks, oil was $92 a barrel about a year ago. And currently it's about 39, and it did hit a low of about 37. So that's just been an excruciating move, especially for oil companies, and also, of course, for Canada, which is a large exporter of oil. And that's one of the reasons why our dollar is dropped about 20% sort of over the last year and change. If you think of the Chinese market, this is another amazing story that's unfolded in terms of volatility. And I'm sure, again, you're hearing a lot about this. The Chinese market year to date is actually down about 8%. Now, think about this for a second. Just going back about a month and a half ago, the Chinese market year to date would have been up 60%. And so you've had this wild move in the Chinese market. But even if you go back another year, a year ago at this time, and you look at where the Chinese market was at that point versus today, the Chinese market actually is still up about 20-odd%. So the Chinese market, as you have probably been listening to the news, it can move 7, 8, 9% in a day. And so there's a lot of crazy things going on. And I'm not going to go into all the details of why that's taking place in all of the individual markets. But I do want to speak to the sort of the bigger picture issues, if you will, globally, because we've talked about this. Some of this volatility really shouldn't be a surprise to long-term investors given the challenges in the market. So number one, why is all this taking place? Because we live in a world that is just awash in debt, and it's going to be very difficult to keep this debt increasing. And so we're getting to the point sort of at the end of this super cycle of debt buildup, and we're seeing the tensions now evolve. Along with the global buildup in debt, monetary conditions, that is interest rates and the printing of money and access to capital, has been way too easy for too long, and the central banks have just flooded the system with way too much money, and we become addicted to this. And so we're now at the point where the central banks are trying to get off this addiction, and we're seeing the tension in the marketplace as the Federal Reserve in the United States tries talk up interest rates, it's finding that's going to be a pretty difficult project. It's going to be very difficult to get rates up. And that's because the monetary conditions have been way too easy given the global debt that we have in the world as we try to keep that debt afloat, if you will. The third issue, which ties into the global debt and the monetary conditions that are way too easy, is this currency war. If you're following some of the moves in the currencies around the world, including the devaluation of the Chinese yuan, we've got country after country after country trying to keep their currency as low as possible because they want to try to be as competitive as possible when it comes to their exports. Their economies are not growing. And so we're in a global economy with virtually no growth, way too much debt, and monetary conditions that really can't be tightened. And so we're getting into currency wars. At this point, the last currency standing is really the US dollar. But we would submit very strongly that the US cannot bear the weight of the whole global economy, and the US economy is not strong enough to do that. And so there will be tremendous pressure eventually on the Fed not to increase rates, certainly not increase them very much. And eventually there'll be a lot of pressure for them to probably even print money again if we get back into a QE4 situation. So with all of that backdrop, what do you do? What are we doing? How are we sort of preparing the portfolios on a day-to-day basis? Well, number one, as we've said to you before, you diversify. You buy great quality companies and you diversify. Number two, you don't leverage and you make sure you've got cash reserves. And so we've got cash reserves in your account so that it minimizes volatility, or at least takes some of the volatility out, and allows us opportunities to dollar cost average and to buy great companies if they come down in value sort of to the price ranges that we want. So number one, diversify. Number two, keep cash reserves. Number three, buying quality businesses that are going to be around for the long term. And those businesses have strong balance sheets and they're very well positioned. What we like, again, are companies that are well financed because they can buy up weak competitors. So in a tough global environment, the better and stronger companies will get bigger and bigger. Even if their share prices are coming down, it does not matter because the underlying company is becoming stronger and becoming better positioned in the marketplace. So from our perspective, we actually have a list of companies we want to own as prices come down. We actually had a window there Monday morning. Some of you probably saw that the market dropped 1,000 points just in a matter of seconds when the market opened in the United States, and that's on the Dow Jones Industrial Average. And we had a couple companies that we couldn't believe, but there wasn't enough time to scoop up and add some of those to the portfolios the way we wanted to. But we believe it will come to us. And so we're very excited about the market volatility. I mean, if you're in this business, you have to have a sort of perverse view, if you will, of the markets, and you have to kind of want to take advantage of the volatility, and that's what we're doing in the portfolios. But we expect this to continue because of the fundamental challenges that are facing the global economy, and we're going to have to work these challenges ultimately to the benefit of our investment portfolios by buying great companies. So that's what we're doing. If you have questions, please give us a call, email, and so on. But we're busy working away on the portfolios and continue looking for opportunities, and actually talking to quite a few companies. We've scheduled quite a few conference calls over the summertime with companies so that we can keep abreast of all of the information that's coming at us and looking at opportunities. So thank you very much. Trust your summer is going well, and we'll be in contact with you over the next few weeks. Thank you very much. Bye now.